In this lesson, our goal is to simplify the complex Affordable Care Act. The Affordable Care Act is quite lengthy. In fact, to create this presentation, we had to combine information from many different sources, including the IRS website, Department of Labor, Small Business Administration, and healthcare.gov, just to name a few. As you may be aware, the Affordable Care Act, also known as ObamaCare, will affect individuals and organizations. We have broken this down into two sections: employers and individuals. We feel this breakdown will help clarify how the plan will apply to businesses and taxpayers. Let's go ahead and take a look at employers first. Before proceeding, an employer needs to determine if they are classified as a small employer or a large employer. The Affordable Care Act, or healthcare law, contains new benefits and responsibilities for employers. The size and structure of their workforce, small, large, or part of a group, helps determine what applies to them. However, if they have no employees, the following information does not apply. In order to determine if the employer is a large employer, they must have at least 50 full-time equivalent employees or a mixture of full-time and part-time employees that equal to at least 50 full-time employees. For purposes of the FTE, 2 part-time employees equal 1 full-time employee. A full-time employee for the FTE is anyone that works at least 30 hours per week. Part-timers will work at least 15 hours per week. So if you have 2 employees that are working 15 hours per week, they are part-time employees, they will be considered 1 full-time employee for purposes of the FTE. The number of employees they have in 2014 will determine whether they are a large or small employer and whether or not they will be subject to the shared responsibility payment for 2015. This is discussed later. Here are a couple of examples. If you have 100 part-time employees, that's going to equal 50 full-time equivalent employees if they've worked at least 15 hours per week. If you have 25 full-time employees plus 40 part-time employees that worked at least 15 hours a week, that's going to equal 45 full-time equivalent employees. That's because you have 40 part-timers, which equal 20 full-timers plus 25 full-timers, that's 45. In the first example, the employer would be a large employer. In the second example, the employer would be a small employer because they did not go over the 50 FTE employees. As you can see, it is very important to carefully examine employees' working hours. A 40-hour-a-week employee is not the only consideration, and just putting employees on part-time will not exempt you from this law. Now that we understand what an FTE full-time equivalent employee is, we can now get into the differences between small employers and large employers and how the law will apply to them. So a small employer is anyone with less than 50 FTE full-time equivalent employees. If an employer is a small employer, they will not be responsible for the shared responsibility payment. Again, we're going to discuss this later. But there are other issues for small employers to be aware of. First, coverage. Beginning on October 1st, 2013, they can purchase affordable health insurance through the Small Business Health Options Programs, also called SHOP, for their employees if they would like. No small employer has to offer coverage. Technically, they say no employer in general has to offer coverage, but in reality, if you're a large employer, then you will have to offer coverage or be subject to the employer shared responsibility part of the law. Additionally, employers can provide coverage outside of the SHOP marketplace if they would like. Again, for a small employer, this coverage is optional. They do not have to provide it, but if they would like, they can do it through the SHOP program or outside the SHOP program. Effective for calendar year 2015, if they provide self-insured health coverage to their employees, they must file an annual return reporting certain information for each employee they cover. For 2014, this rule is optional. They may be required to report the value of the health insurance coverage they provided to each employee on his or her Form W-2. Employers that provide applicable employer-sponsored coverage under a group health plan are subject to the reporting requirements. This includes businesses, tax-exempt organizations, and federal, state, and local government entities. Reporting the cost of healthcare coverage on the Form W-2 does not mean that the coverage is taxable. The value of the employer's excludable contribution to health coverage continues to be excludable from an employee's income, and it is not taxable. This reporting is for informational purposes only and will provide employees useful and comparable consumer information on the cost of their healthcare coverage. Small employers may be eligible for the small business healthcare tax credit if they cover at least 50% of their full-time employees' premiums costs and they have fewer than 25 full-time employees with average annual wages of less than $50,000. For 2013, the maximum credit is 35% of premiums paid for small business employers and 25% of premiums paid for small tax-exempt employers such as charities. In 2014 and later, there will be changes to the credit. The maximum credit will increase to 50% of premiums paid for small business employers and 35% of premiums paid for small tax-exempt employers. To be eligible for the credit, a small employer must pay premiums on behalf of employees enrolled in a qualified health plan offered through a small business health options program, the SHOP Marketplace. The credit will be available to eligible employers for 2 consecutive taxable years. So here's what this means for employers. If they pay $50,000 a year towards workers' health care premiums, and if they qualify for a 15% credit, they will get a $7,500 credit. If a small business employer did not owe tax during the year, they can carry the credit back or forward to other tax years. Also, since the amount of the health insurance premium payment is more than the total credit, eligible small businesses can still claim a business expense deduction for the premiums in excess of the credit. To claim the credit, employers must use Form 8941, Credit for Small Employer Health Insurance Premiums, to calculate the credit on their tax return. There is a notice to employees requirement. Small business employers that gross more than $500,000 in annual sales must provide each employee at the time of hiring, or with respect to current employees no later than October 1st, 2013, a written notice that includes informing the employee of the existence of the health insurance marketplace, including a description of the services provided by the marketplace and the manner in which the employee may contact the marketplace to request assistance. They must also include in that letter if the employer plan's share of the total allowed cost or benefits provided under the plan is less than 60% of such costs, and that employee may be eligible for a premium tax credit under Section 36B of the Internal Revenue Code. They also must notify the employee if the employee purchases a qualified health plan through the marketplace, the employee may lose the employer contribution, if there is any, to any health benefits plan offered by the employer, and that all or a portion of such contributions may be excludable from income for federal income tax purposes. Now, for all current employees, they need to be notified by October 1st, 2013, and in the future, you have to notify all new employees upon hiring. Now, just a side note here, there have been articles circulated on the internet stating that employees that meet the $500,000 gross annual sales test that it failed to notify employees could be subject to a $100 a day penalty for noncompliance. I have found no proof of this on any of the government sites. In fact, on SBA.gov, there is a blog by Meredith Olafson that specifically states that this penalty is a myth. However, with this entire provision, there has been a very carefully crafted language to say there are no fees or penalties where there actually are some. This particular blog says there is no fine or penalty under the law for failing to provide a notice. But in other areas, they say that no business is required to provide health insurance to their employees. We know from this lesson that if an employer meets the requirements to be a large employer and does not provide insurance, they will have a fine under the employer shared responsibility. Instead of calling it a fine or penalty, they call it the employer shared responsibility. I don't know if there will be a fine or other monetary payment described as something other than a fine or penalty, but I also think that if an employer must notify its employees by October 1st and does not, then there must be some sort of repercussion. Otherwise, why would they make it a requirement? My advice, mail the notice and be in compliance and don't take the risk. Also, regarding the gross income of $500,000 in annual sales, that test does not apply to hospitals, institutions that primarily engage in the care of the sick, the aged, mentally ill, or disabled who reside on the premises, schools for children who are mentally or physically disabled or gifted, preschools, elementary and secondary schools, and institutions of higher education. This means that regardless of the business gross income, they will have to notify all employees with this written notice. Now let's take a look at large employers. Businesses are considered large employers if they have 50 or more FTE employees. There have been changes to the requirements for large employers. Originally, employers would have had annual reporting responsibilities take effect in 2014, but now that has been pushed back to 2015. First, let's take a look at coverage that large employers are required to provide. Large employers will not be able to use the SHOP Marketplace, the Small Business Health Options Program, to offer health insurance to their employees. However, in 2016, the SHOP Marketplace will be available to employers with up to 100 full-time equivalent employees. They will need to use outside providers to provide health insurance for their employees. Effective for calendar year 2015, they must file an annual return reporting whether and what health insurance they offered their employees. This rule is optional for 2014. This report must include the date the return is filed. It must certify whether the applicable large employer offers its full-time employees and their dependents the opportunity to enroll in minimum essential coverage under an eligible employer-sponsored plan, and if so, they have to certify the duration of any waiting period with respect to such coverage, the months during the calendar year when coverage under the plan was available, the monthly premium for the lowest cost option in each enrollment category under the plan, and the employer's share of the total allowed cost of benefits provided under the plan. They must also report the number of full-time employees for each month of the calendar year. They must also report for each full-time employee the name and address and taxpayer identification number of the employee and the months, if any, during which the full-time employee or any of their dependents were covered under the eligible employer-sponsored plan. And they may also have to provide additional information as required by the Secretary of the Treasury. They also may be required to report the value of the health insurance coverage provided on the Form W-2, similar to the small employer. Employers must furnish to employees by January 31st following the calendar year a written statement that includes the employer's name and address, the employer's contact information, including a contact phone number, the information relating to the coverage provided to that employee and their dependents that is required to be reported on the return. Effective for calendar year 2015, they may have to make a payment if they do not offer adequate affordable coverage to their full-time employees and one or more of those employees gets a premium tax credit. So be aware there could be a fee if they're not providing adequate coverage. Large employers are also subject to the notice to employees requirement. Similar to the rules for small businesses, employers that gross more than $500,000 in annual sales must provide each employee at the time of hiring a written notice. And that written notice was discussed in the small employers section. Now we spoke earlier about the shared responsibility payment. The shared responsibility payment is a fee that will be imposed on large businesses. Beginning in 2015, employers with 50 or more full-time equivalent employees that do not offer affordable health insurance that provides minimum value to their full-time employees and dependents may be required to pay an assessment if at least one of their full-time employees is certified to receive a premium tax credit in an individual health insurance marketplace. There is an exception to this rule, and that's for seasonal workers. If an employer's workforce equals or exceeds 50 full-time equivalent employees for 120 days or fewer during a calendar year solely due to seasonal workers, the employer is exempted from the shared responsibility payment. The reason for the employer's shared responsibility assessment is to offset part of the cost of the marketplace premium tax credits that an employee would receive if not covered by the employer. The amount of the payment is based partly on whether the business offers insurance. The reason for the employer's shared responsibility assessment is to offset part of the cost of the marketplace premium tax credits that an employee would receive if not covered by the employer. The amount of the payment is based partly on whether the business offers insurance. Unlike employer contributions to employee premiums, the employer's shared responsibility payment is not tax deductible. So if a large employer decides not to provide health care to its employees, they will be subject to the employer's shared responsibility assessment, and it will not be tax deductible. So how much will this fee be? If they don't offer insurance, the annual payment is $2,000 per full-time employee, excluding the first 30 employees. If they do offer insurance, but the insurance doesn't meet the minimum requirements, the annual payment is $3,000 per full-time employee who qualifies for premium savings in the marketplace. So for example, if you have 50 FTE employees and you do not provide coverage, you will be exempted from the first 30 employees, so that means you'll be paying $2,000 per employee for the next 20 employees. That comes out to $40,000 for not providing healthcare coverage to your employees. That takes care of the employer section, so how will this now affect individuals? With regard to individuals, individual tax effects and requirements will depend on what coverage is provided by the employer. Remember that an employee could be covered by the employer, but their family may not be covered. When this occurs, the family not covered would fall into the individual requirements. Also, anybody not covered would fall into the individual requirements. Individuals or family members that are not covered by an employer plan will need to enroll in their own plan or be subject to the shared responsibility payment. Individuals or family members that are not covered by an employer plan will need to enroll in their own plan or be subject to the shared responsibility payment. This is not the same payment that we discussed in the prior section, and we will discuss this in a moment. They also could qualify for a premium tax credit to help offset their cost of the plan, and we'll discuss that later as well. On October 1st, 2013, open enrollment begins to purchase healthcare coverage through the new health insurance marketplace. If an individual or their family does not have healthcare coverage by January 2014 or have an exemption from coverage, they will be subject to the individual shared responsibility payment in 2015, a year later. There is a premium tax credit to help offset some costs. For those that are not covered by an employer health plan, there is the premium tax credit to help offset some of your costs in that plan. This credit is an advanceable and refundable tax credit designed to help eligible individuals and families with low or moderate income afford health insurance purchased through the health insurance marketplace. Since this is an advanceable credit, this means that individuals can choose to have the credit paid in advance to their insurance company starting in 2014 to lower what they pay for their monthly premiums. The advance payment could be problematic though for some. The advance amount is calculated based off of information provided by the taxpayer regarding their family composition and projected household income. If an individual provides information that is either inaccurate or changes from what they estimate, they could end up having to pay part of the credit back. Those that take the advance credit must report on their tax return the amount received and reconcile that with the actual credit to be taken. The difference will either be refunded back or paid back. Taxpayers can notify the marketplace about changes in their circumstances. The advanceable credit can then be adjusted based on these changes. This will decrease the likelihood of a significant difference between the advance credit payments and the actual premium tax credit. So what kind of changes and circumstances could affect somebody's advanceable credit? If they had an increase or a decrease in their household income, they got married, they got divorced, they had a birth or adoption of a child, gaining or losing eligibility for government-sponsored or employer-sponsored healthcare coverage through their employer, for example. Since the advanceable credit could be problematic, if individuals choose not to receive the advance payment, they can claim the credit still, but they'll do that on their tax return for that year. So for 2014, you'll be able to file that in 2015 and get the credit on the 2014 tax return. Since this is a refundable credit, this means that they will be able to receive the full amount back even if they have no tax due. Anyone that is entitled to this credit should file a tax return even if they are below the filing requirements to ensure they receive the refundable amount. If they receive the advanceable credit, they must file a tax return to report how much was received and to verify the correct amount was taken. To be eligible for the premium tax credit, an individual must meet all of the following requirements. They must purchase coverage through the marketplace, have household income that falls within a certain range, which we'll discuss in a moment, They are not able to get affordable coverage through an eligible employer plan that provides minimum value, which we'll discuss in a moment, and they are not eligible for coverage through a government program like Medicaid, Medicare. They must also file a joint return if they're married, and they are not claimed as a dependent by another person. It is important to note that an individual may be covered by a work plan, but their family may not be covered. If this occurs, then the rules above would apply to that family member regarding the credit. For example, John is covered by his work. His wife Amy is not covered by the work plan. John could not qualify for the premium tax credit because he is able to get affordable coverage through an eligible employer. But his wife Amy could qualify if the other tests are met because she cannot get affordable coverage through an eligible employer plan. Household income for purposes of the premium tax credit is the modified adjusted gross income, also known as MAGI, M-A-G-I, of every individual in the family for whom they can properly claim a personal exemption deduction for and who is required to file a federal tax return. So what is MAGI, the modified adjusted gross income? The MAGI for this credit is the adjusted gross income from the taxpayer's tax return plus any excluded foreign income, non-taxable Social Security benefits, and tax-exempt interest received during the taxable year. The household income must be between 100% and 400% of the federal poverty line for their family size for the year. For 2013, an individual making between $11,490 all the way up to $45,960 would be between the 100 and 400% range. For a family of two, that range would be $15,510 all the way up to $62,040. For a family of four, it would be $23,550 all the way up to $94,200. You can get updated poverty line amounts by going to hhs.gov for more information. These amounts are adjusted annually and they will change next year. So for the premium tax credit, if you determine that your household income is between the 100 and 400% poverty line and you're eligible, meeting all the other eligibility requirements, then you can determine how much your credit will be. The law will base the size of the premium tax credit on a sliding scale. Those who have a lower income get a larger credit to help cover the cost of their insurance. Those with a higher income will receive a lower credit. The credit amount is generally equal to the difference between the premium for the benchmark plan and the taxpayer's expected contribution. The expected contribution is a specified percentage of the taxpayer's household income. The percentage increases as income increases, from 2% of income for families at 100% of the federal poverty level to 9.5% of incomes for families at 400% of federal poverty level. The actual amount a family pays for coverage will be less than the expected contribution if the family chooses a plan that is less expensive than the benchmark plan. The benchmark plan is the second lowest cost plan that would cover the family at the silver level of coverage. The credit is capped at the premium for the plan the family chooses, so no one receives a credit that is larger than the amount they actually pay for their plan. So while this is a refundable credit and it's an advanceable credit, you cannot receive more than you actually pay for your healthcare coverage. So let's take a look at some examples. A family of four with income of $50,000, they're going to purchase a benchmark plan. The premium tax credit is generally set based on the benchmark plan. The family expected contribution is a percentage of the family's household income. So their household income as a percentage of the federal poverty limit is 224%. Based off of that, the expected family contribution will be 7.14% of their income. This will be published later by the IRS. So the expected family contribution would be $3,570. The premium for a benchmark plan in this example is $9,000. This taxpayer will receive a premium tax credit of $5,430, and that's going to be $9,000 is what they actually paid for the benchmark plan. Then they're going to receive $5,430 for the premium tax credit, and they're going to have an actual family contribution of $3,570 towards their healthcare coverage. Now let's take a look at that exact same scenario, but they decide to purchase a less expensive plan. So they choose a plan that is less expensive than the benchmark plan. The family will generally pay less, thereby creating an incentive to choose a less costly plan and reducing the overall healthcare cost. So again, their income as a percentage of the federal poverty limit was 224%, and their expected family contribution of 7.14% is going to be $3,570. The premium for the benchmark plan is $9,000, and the premium tax credit is going to be $5,430 still. So all that remains the same. However, the plan the family chose was $7,500. So the actual family contribution now is $2,070 rather than the $3,570 from the prior plan because they chose a less expensive plan. So for purposes of this credit, individuals are encouraged to get a less expensive plan below the benchmark plan in order to help pay for their costs. Not every individual is going to receive a 100% reimbursement for health care paid in. There will be out-of-pocket expenses for many individuals and their families. Starting on January 2014, individuals and their families must either have health care coverage, an exemption from coverage, or make a payment when they file their 2014 tax return in 2015. The provision applies to individuals of all ages, including children. The adult or married couple who can claim a child or another individual as a dependent for federal income tax purposes is responsible for making the payment if the dependent does not have coverage or an exemption. So if you're claiming somebody on your tax return, you are required to make the individual shared responsibility payment on their behalf or provide health care coverage for that individual. The provision goes into effect on January 1st, 2014. It applies to each month in the calendar year. The month of any payment owed takes into account the number of months in a given year and individuals without minimal essential coverage or an exemption. So what is minimal essential coverage? Minimum essential coverage is going to include employer-sponsored coverage, coverage purchased in the individual market, including a qualified health plan offered by the health insurance marketplace, also known as the Affordable Insurance Exchange, Medicare Part A coverage and Medicare Advantage plans, most Medicaid coverage, Children's Health Insurance Program, certain types of Veteran Health Coverage Administration by the Veterans Administration, TRICARE, coverage provided to Peace Corps volunteers, coverage under the Non-Appropriated Fund Health Benefit Program, refugee medical assistance supported by the Administration for Children and Families, self-funded health coverage offered to students by universities for plan or policy years that begin on or before December 31st, 2014, state high-risk pools for plan or policy years that begin on or before December 31st, 2014. Minimum essential coverage does not include coverage provided only limited benefits, such as coverage only for vision care or dental care, and Medicare covering only certain benefits such as family planning, workers' compensation, or disability policies. There are statutory exemptions from the requirement to obtain minimum essential coverage. Some of those are religious conscience, healthcare sharing ministry, Indian tribes. You don't have a filing requirement because your tax return is below the minimum threshold for filing the tax return, hardship, unaffordable coverage options, incarceration, or you're not lawfully present, you're not a U.S. citizen, a U.S. national, or an alien lawfully presented in the U.S. If you're in one of those categories, you're exempted from the individual shared responsibility payment. So how much is the individual shared responsibility payment? The amount of the shared responsibility payment for any taxable year is generally the sum of monthly penalty amounts for all months in the taxable year in which non-exempt individuals for whom the taxpayer is liable did not have minimum essential coverage. The shared responsibility payment amount for any taxable year may not exceed any amount equal to the national average premium for bronze level qualified health plans offered through exchanges for the applicable family size involved. The monthly penalty amount for a month is equal to 1/12 of the greater of the following amounts: the flat dollar amount or the percentage of income. The flat dollar amount is the lesser of the sum of the applicable dollar amounts for all non-exempt individuals without minimum essential coverage for whom the taxpayer is liable, or 300% of the applicable dollar amount. So what is the applicable dollar amount? The applicable dollar amount is $95 for 2014, $325 for 2015, and $695 for 2016, and will be increased for calendar years beginning after 2016 by a cost of living adjustment. If a non-exempt individual has not attained the age of 18 as of the beginning of a month, the applicable dollar amount for that individual is 1/2 of the regular applicable dollar amount. The percentage of income is calculated as the excess of the taxpayer's household income over the taxpayer's federal income tax return filing threshold multiplied by a percentage figure. The percentage figure is 1% for taxable years beginning in 2014, 2% for taxable years beginning in 2015, and 2.5% for taxable years beginning after 2015. All right, that computation is very complex, but here's a small example. A taxpayer does not have coverage for 12 months. The minimum penalty would be $95 for 2014 times the months with no coverage, which was 12 months without coverage, divided by 12. So their fee would be $95. So you may ask, why do we multiply it by 12 and then divide it by 12? Well, that's for somebody without coverage for the entire year. But if they had coverage for 10 months, let's say, then we would multiply the $95 fee by the 2 months that they had no coverage and then divide that by 12. But let's take this a step further because the payment could end up being much more. Let's take a look at a married couple earning $70,000. The taxpayer and spouse do not have coverage for 12 months. The minimum penalty would be $1,010 for 2014. And that would be because they have $70,000 in gross income. We get to subtract off their filing threshold of $19,500, so that we're left with $50,500. For 2014, we have to multiply that by the percentage, and that percentage is 1%, so that comes out to $505. And they had 12 months with no coverage, so we need to multiply the 505 times 12, and then divide by 12, and then multiply it by 2 for both the taxpayer and the spouse, and we get $1,010 penalty. So in order to properly calculate the credit, we must look at it from both factors. 1, the flat dollar amount, and 2, the percentage of income amount. Whichever is larger is the amount that you're going to pay. For 2014, we are not going to see a large penalty imposed on people, but in 2015, it's going to increase significantly. Additionally, those without coverage in 2014 are going to be subject to the penalty in 2015, and at that point, it'll be too late to do anything to remove that penalty. That means on October 1st, 2013 through January of 2014, people must get coverage. If they do not get coverage within this time period, they will be subject to the penalty the following year. If a taxpayer is covered by their employer, it is important to note a couple of items. First, whether or not they are covered by an affordable and minimum value plan, and second, that they will be responsible for the premium portion not covered by the employer. So what is an affordable and minimum value plan? An employer-sponsored plan is affordable if the portion of the annual premium paid for self-only coverage does not exceed 9.5% of household income. The affordability test applies only to the portion of the annual premiums for self-only coverage and does not include any additional cost for family coverage. If the employer offers multiple health coverage options, the affordability test applies to the lowest cost option available to the employee that also satisfies the minimum value requirement. If the employer offers any wellness programs, the affordability test is based on the premium an employee would pay if they received the maximum discount for any tobacco cessation programs and did not receive any other discounts based on wellness programs. An employer-sponsored plan provides minimum value if the plan covers at least 60% of the expected total costs allowed for covered services. Beginning in 2014, the employer will provide employees with a document called a Summary of Benefits and Coverage. This should help explain what they're getting and if it meets the affordable and minimum value plans. When an employer provides coverage to their employees, they do not have to pay the entire premium. If they pay only 50% of the premium of the employee then must pay the other 50% of coverage. If the coverage provided by the employer is not affordable and does not provide minimum value, then the employee can qualify for the premium tax credit. But if the coverage provided by the employer does meet the affordable and minimum value test, then the employee does not qualify for the premium tax credit. This could result in additional out-of-pocket expenses that an employee must pay to cover their costs. This could come as a shock to those currently not covered by plans at work. In conclusion, businesses should be aware of the responsibility based on how many employees they have. They should also be aware that how those employees are counted is specific to this program. Individuals should be aware that employers are not required to cover their family members. Additionally, employers will not be required to cover 100% of the cost of the program. Employees should be prepared to have extra money going toward health insurance for themselves and their families. The credit to offset these costs will not apply to many families, and lack of planning could hit those families hard financially. The Affordable Care Act can be very confusing and is constantly changing. By separating the program by what pertains to individuals and businesses, it can help clear the fog. The Act contains descriptions for fees, credits, and penalties that are not normally seen in tax law. Don't let these descriptions confuse you. Know them for what they are and try to comply as necessary. Be aware that some states have their own healthcare exchange programs. Check with your state to see if they are using their own exchange program or if they are using the SHOP marketplace.